Chapter 9, Corporate Actions. Learning Objectives. After studying this chapter, you should know about the following corporate actions and their implications. Dividends, rights issue, bonus issue, stock split and consolidation, mergers and acquisitions, demerger/spin-off, scheme of arrangement, loan restructuring, buyback of shares, delisting and relisting of shares, share swap, philosophy of corporate actions. A company initiates several actions apart from those related to its business that have a direct implication for its stakeholders. These include sharing of surplus with the shareholders in the form of dividends, changes in the capital structure through the further issue of shares, buybacks, mergers and acquisitions and delisting, raising debt, and others. In a company that has made a public issue of shares, the interest of the minority investors has to be protected. Corporate actions are regulated by provisions of the following. Provisions of the Companies Act, 2013. Relevant regulations of SEBI and terms of the listing agreement entered into with the stock exchange. All corporate actions, therefore, need to follow the requirements prescribed by these regulations. This includes giving notice to the regulators, stakeholders, and following the disclosure norms laid down in the applicable clauses. Corporate benefits and actions, as defined above, apply to all investors who appear in the register of members if the shares are held in physical form, or investors whose names appear in the register of beneficial owners maintained by the depository, in case of dematerialized shares. In order to determine this, the company announces a record date or book closure period, and investors whose names appear on the records on this date become eligible shareholders to receive notice of the relevant corporate action and benefit. There are several corporate actions possible, and some of them are defined below. Dividend. Post-tax profits in a business belong to the shareholders, and a company can broadly do two things with those profits: retain them for investment in the business or return to the shareholders. If a company chooses to return money to all shareholders in equal proportion, it is said to have declared a dividend. In practice, companies distribute part of the profits and retain part of the profits in the business. The proportion of distribution and retention of profits will depend upon the opportunities available for plowing back the profits into the business, nature of management, expectation of shareholders, and ultimately the availability of cash in the business to distribute to the shareholders. A company may declare interim dividends during the financial year and a final dividend at the end of the year. A company has to pay dividends within 30 days of its declaration. SEBI has mandated that listed companies shall declare dividends, if any, in rupee terms on per-share basis, as against the earlier practice of declaring dividends as a percentage of the face value. This is to avoid confusion among investors while comparing dividends on various shares of different face values. For example, if 50% dividend is declared by two companies A and B with different face values of 2 rupees and 10 rupees, respectively, an investor in Company A will receive 1 rupee as dividend as against 5 rupees in the case of Company B. Dividends received by the investors in two companies are different even though the percentage is the same because the face value of the shares is different. In the interest of the investors, Company A is now required to declare the dividend as 1 rupee per share, while Company B will declare the dividend payable as 5 rupees per share. Historical dividend track record of a company may be seen from the payout ratio, which is calculated by dividing the company's dividend per share by earnings per share. In India, the entire dividend is now taxable in the hands of the shareholders. The company deducts 10% tax under Section 194 of the IT Act on dividend income more than 5,000 rupees while crediting the dividend in the shareholders' account. Rights issue. When a company needs additional equity capital, it has two choices: ask more money from existing shareholders or go for a fresh set of investors. If a company chooses the latter, that is, issues shares to a fresh set of investors, the proportionate holding of existing shareholders gets diluted. For example, a company may have 10 lakh shares of 10 rupees each, amounting to an issued and paid-up capital of 1 crore rupees. If it issues another 10 lakhs shares to a fresh set of investors to increase its capital, the proportion held by existing shareholders will come down by half as the issued and paid-up capital has doubled. This is called as dilution of holdings. To prevent this, the Companies Act requires that a company which wants to raise more capital through an issue of shares must first offer them to the existing shareholders, and such an offer of shares is called a rights issue. Subscribing to the rights issue is a choice and not a compulsion for investors. They may buy shares offered to them under rights issue or let the choice expire without any action, or may choose to transfer their rights or entitlement to another person for consideration, sell, or without consideration under love and affection. This is called renunciation of rights. Rights entitlements also get traded on the stock exchange for a defined period. Shares under rights issues are generally offered at a discount to the prevailing market prices. Logically, also, if the price under a rights issue is higher than the market price of stock, investors would be better off buying shares from the market without subscribing to the issue. Let us assume a shareholder A has 10 shares of a company whose share price is 100 rupees. If the company is in further need of capital, it could get this capital from its existing shareholders by offering shares at a discounted price. The number of discounted shares a shareholder can buy depends on the number of shares held by him and the ratio offered under rights issue. For example, if the company issues 1-for-2 rights issue at 70 rupees per share, shareholder A will have right to buy 1 share for every 2 shares held by him at 70 rupees. As A has 10 shares, he can buy 5 more shares at 70 rupees. In practice, companies allow shareholders to apply for additional shares beyond their entitlement because some shareholders may neither apply for shares under their entitlement nor transfer their rights to others, and those shares may be available for issuance to these shareholders who desire additional shares. A rights issue of shares must follow all SEBI's regulations on issue of shares. A listed company making a rights issue shall fix a record date to determine the eligibility to the rights. The company must issue a letter of offer giving details of the issue, including the purpose for which funds are being raised. The draft letter of offer must be filed with SEBI. An abridged letter of offer must be dispatched to all investors at least 3 days before the issue opens. Investors can also apply on a plain paper if they do not receive the application form. A rights issue is open for subscription for a minimum period of 15 days and a maximum period of 30 days. As a result of rights issue, the total number of outstanding shares goes up with a corresponding increase in the cash on the assets side of the balance sheet. If all shareholders subscribe to their full entitlements/rights, their proportionate ownership remains unchanged and the number of shares held by them goes up. Bonus issue. A bonus issue, also known as equity dividend, is an alternative to cash dividend. Bonus shares are issued to the existing shareholders by the company without any consideration from them. The reserves lying in the books of the company shareholders' money gets transferred to another head, that is, paid up/subscribed capital. The shareholders do not pay anything for these shares, and there is no change in the value of their holdings in the pre- and post-bonus stages. The issuance of bonus shares is more to influence the psychology of investors without any economic impact. The entitlement to the bonus shares depends upon the existing shareholding of the investors. A bonus issue in the ratio of 1:3 entitles a shareholder for 1 bonus share for every 3 shares held by them. The company makes the bonus issue out of its free reserves built from genuine profits. Reserves built from revaluation of assets are not allowed to be considered for making a bonus issue. A company cannot make bonus issue if it has defaulted on payment of interest and/or principal on any debt security issued or any fixed deposit raised. Issuance of bonus shares is termed as capitalization of reserves. As the total number of shares goes up without any economic change in the profit and loss statement or balance sheet, per share data, earnings per share, book value per share, market price per share, etc., witnesses immediate deterioration. However, as shareholders' proportionate ownership remains unchanged and the number of shares held by them goes up at overall ownership level, there is no negative impact to the shareholders. For example, if shares of a company were trading at a price of 1,000 rupees per share prior to bonus, post-bonus on 1:1 basis, fair price of share is likely to come down to 500 rupees per share to maintain post-bonus market value of a holding equivalent to its pre-bonus market value. Therefore, mathematically, the value of the investors holding pre-bonus at 1 lakh rupees, that is 100 shares times 1,000 rupees, remains the same 1 lakh rupees, that is 200 shares times 500 rupees, post-bonus. Actual market price of share post-bonus will be around 500 rupees, not exactly at of 500 rupees, as it will depend on market factors of demand and supply. Stock split. A stock split is a corporate action where the face value of the existing shares is reduced in a defined ratio. A stock split of 1:5 means splitting an existing share into 5 shares. Accordingly, the face value of shares will go down to 1/5 of the original face value. For example, if an investor holds 100 shares of a company with a face value of 10 rupees each, a stock split in the ratio of 1:5 will increase the number of shares held by him to 500, but the face value of each share will go down to 2 rupees. From the company's perspective, there is no change in its share capital since an increase in the number of shares is offset by a fall in the face value and resultant multiplier of face value and outstanding number of shares remains the same. Companies consider splitting their shares if prices of their shares in the secondary market are seen to be very high, restricting the participation by investors. As price per share comes down post-split, share split leads to greater liquidity in the market. Similar to bonus, split is also a book entry resulting in increased number of outstanding shares in the books of the company with reduced face value without any economic benefit whatsoever to the shareholders. We may say that share split is also to influence the psychology of investors of reduced market price per share and to impact liquidity in the marketplace without any economic benefit to the shareholders. As the total number of shares goes up without any economic change in the profit and loss statement or balance sheet, per share data, earnings per share, book value per share, market price per share, etc., witnesses immediate deterioration. However, as shareholders' proportionate ownership remains unchanged and number of shares held by them goes up at overall ownership level, there is no negative impact to the shareholders. For example, SBI initiated a stock split of its equity shares from a face value of 10 rupees to 1 rupee. A shareholder holding 1 share of a face value of 10 rupees will now hold 10 shares each with a face value of 1 rupee. The stock that was trading in the markets at over 2,700 rupees at the time of the announcement traded post-split at around 295 rupees. The value of the shareholders' holding was around 2,700 rupees, 1 share times 2,700 rupees, prior to the stock split. Post the split, the value of the holding is 2,950 rupees, 10 shares times 295 rupees. The market price after the split will depend upon the market forces of demand and supply. Share consolidation. Share consolidation is the reverse of stock split. In a share consolidation, the company changes the structure of its share capital by increasing the par value of its shares in a defined ratio and correspondingly reducing the number of shares outstanding to maintain the paid-up/subscribed capital. A stock consolidation of 5:1 means consolidation of 5 existing share into 1 share. Accordingly, the face value of shares will go up 5 times of the original face value and the number of outstanding shares will become 1/5 the original number. For example, if an investor holds 500 shares of a company with face value of 2 rupees each, a stock consolidation in the ratio of 5:1 will reduce the number of shares held by him to 100, but the face value of each share will go up to 10 rupees. From the company's perspective, there is no change in its share capital since decrease in the number of shares is offset by corresponding increase in the face value. Companies consider consolidating their shares if prices of their shares in the secondary market are seen to be very low, affecting the perception of investors. An increase in the price per share post-consolidation leads to better perception among the market participants about the company's prospects. Similar to bonus and split, share consolidation is also a book entry resulting in reduced number of outstanding shares in the books of the company with increased face value without any economic benefit whatsoever to the shareholders. We may say that share consolidation is also to influence the psychology of investors without any economic benefit to the shareholders. As the total number of shares goes down without any economic change in the profit and loss account or balance sheet, per share data, earnings per share, book value per share, market price per share, etc., witnesses immediate improvement. However, as shareholders' proportionate ownership remains unchanged and the number of shares held by them goes down at overall ownership level, there is no positive impact to the shareholders. For example, if shares of a company were trading at a price of 5 rupees per share prior to consolidation, post-consolidation on 5:1 basis, fair price of share is likely to become 25 rupees per share to maintain post-consolidation market value of a holding equivalent to its pre-consolidation market value. Therefore, mathematically, value of the investors holding pre-consolidation 2,500 rupees, 500 shares times 5 rupees remains the same at 2,500 rupees, 100 shares times 25 rupees. Post-consolidation. Actual market price of share post-consolidation will be around 25 rupees, not exactly at 25 rupees as it will depend on market factors of demand and supply. Merger and acquisition. Mergers, acquisitions, and consolidations are corporate actions which result in a change in the ownership structure of the companies involved. In a merger, the acquirer buys up the shares of the target company and it is absorbed into the acquiring company and ceases to exist. The assets and liabilities of the target company are taken over by the acquirer. In an acquisition or takeover, the acquiring company acquires all or a substantial portion of the stock of the target company. Both entities typically continue to exist after the acquisition. In a consolidation, companies combine together to form a new company and the merged companies cease to exist. Following are some of the motives behind M&A activities. Synergy. Each company may have distinct efficiencies that, when combined together, may result in greater economic benefits. The combined entity can benefit from economies of scale, forward and backward integration, and expanding the market for their products and services. Increased revenue and market share. If two competitors go through M&A, it would result in increased revenue and market share for the acquiring entity. Geographical or other diversification. Acquiring company or companies in different geographies or complementary business space may offer significant competitive advantage to the acquirer. Taxation. A profitable company can buy a loss-making company to enjoy tax shield against the losses of the target company. The shareholding pattern of a listed company may change due to a substantial acquisition of shares and voting rights by an acquirer and persons acting in concert with the acquirer. SEBI Substantial Acquisition of Shares and Takeover Regulations 1997 provide relevant triggers and requirements for an acquirer and offer an opportunity to public shareholders to exit from the company in such situations, if they choose to do so. Demerger/spin-off. A spin-off occurs when a company carves one or more of its existing businesses into a separate company. In case of a spin-off, the shareholders on the record date will be eligible to receive shares in the new company in proportion to the shares they held in the parent company. For example, in April 2018, Adani Enterprise spun off its renewable energy business to a new company, Adani Green Energy Limited. Shareholders of Adani Enterprises were given shares in the new company in the ratio of 761:1,000. Earlier, in June 2015, Adani Enterprise spun off its ports and power and transmission businesses into two separate companies, Adani Ports and Adani Transmission, respectively. Scheme of arrangement. Some companies may fail to fulfill their obligation to their creditors or to a certain class of shareholders, example, failure to redeem preference shareholders. Under such conditions, company and the creditors or members may enter into a scheme of arrangement to settle the issue. Scheme of arrangement is a court-monitored settlement process between the company and its creditors or members. It typically involves reorganization of the share capital of the company. It may involve the existing shareholders relinquishing part of their ownership in favor of the creditors or consolidation or division of class of shares. Under Section 230 of the Companies Act 2013, scheme of arrangement can be sought by the company or its creditors/members. The person claiming the scheme of arrangement shall approach the National Company Law Tribunal (NCLT). The tribunal then orders the meeting between the company, its creditors, and/or members to arrive at a compromise or arrangement. Loan restructuring. Loan or debt restructuring is a mechanism available to companies in financial distress who are unable to meet their obligations to their lenders to restructure their debt by modifying one or more of the terms of the loans. This may include the amount of loan, rate of interest, the mode of repayment, funds and/or equity in the company, and the term of the loan, and so that the repayment obligation is within the payment capacity of the borrower. A restructuring exercise is to the advantage of the borrower and the lender. The borrower is given a way to repay the loan that is feasible given the current state of the business and not be declared a defaulter. The company is now able to focus on building back its business and repairing the balance sheet. The lender can expect some repayment from a loan that would otherwise have to be written off as a bad debt. The process of debt restructuring involves analyzing the debt position of the company, meeting with the lenders, providing information on the current and future financial position of the company, and coming up with a workable repayment plan. The lenders have to be provided a concrete business plan on how the company plans to generate the revenues required to meet its obligations under the new terms, as well as meet the financial needs of the business. Buyback of shares. A company may deploy excess cash on the balance sheet in various ways. It may use the money to expand business and grow, or reduce its liability by paying back/reducing its borrowings, if any, and/or to distribute to the shareholders. If it chooses the third option, management needs to choose between homogeneous distribution of this money among all shareholders through dividend, or it would offer a choice to the shareholders to have the money through selling their shares back to the business or in kind in terms of enhanced value of each share, in terms of earning per share (EPS) and book value per share (BV). Motives of buyback of shares could be multiple as follows. To give a value boost to the stock if it is seen as undervalued. Excess cash and lack of profitable investment opportunities. Buyback as a confidence-building measure. Buyback as a defensive strategy against a potential takeover. Buyback to reduce equity and resultantly increase the leverage in the company. Buyback to diffuse the impact of dilution in promoters' holding on account of, say, employee stock option plans, ESOPs. While every management talks about the positive impact of buybacks on minority shareholders, it is very difficult to ascertain management's intention on the buyback of shares. Buyback of shares can be done only out of the reserves and surplus available with the company. The shares bought back are extinguished by the company within the stipulated time frame, and that leads to a reduction in its share capital. To be eligible for a share buyback, a company should not have defaulted on its payment of interest or principal on debentures/fixed deposits/any other borrowings, redemption of preference shares, or payment of dividends declared. The shares can be bought back using the tender method by making an offer to existing shareholders on a proportionate basis, or from the open market through a book-building process, or through the stock exchange, or from odd lot holders. The company needs to pass a special resolution specifying the time frame for buyback and maximum price at which the buyback will be made. As buyback of shares results in the reduction of outstanding shares, even if there is no change in the P&L, it would result in increased EPS for post-buyback shareholders. These shareholders may also enjoy higher dividend on each of their shares. Assuming the market value of shares based on earnings remains the same pre- and post-buyback as it is to be spread over a smaller lot now, the market value per share goes up. Delisting and relisting of shares. Delisting of shares refers to the permanent removal of the shares of a company from being listed on a stock exchange. Delisting may be compulsory or voluntary. In a compulsory delisting, the shares are delisted on account of non-compliance to regulations and the clauses of the listing agreement by the company. In a voluntary delisting, the company chooses to get the shares delisted and go private. The motives may range from regulatory reporting complexities and compliance overhead to mergers and acquisitions, and sometimes to have the freedom to execute a changed strategy. Any voluntary delisting has to happen as defined in the regulations by SEBI. SEBI regulation, among other things, requires that the promoter group provide an exit opportunity to all shareholders. The promoter or promoter group should invite bids to acquire the shares through a reverse book-building process. Under this system, the promoter needs to specify the floor price. Shareholders then specify the price at which they are willing to sell the shares. The promoters can accept the bid price, reject the bid price, cancel the delisting plan, or provide a counteroffer to the public. Voluntary delisting can go through only if the promoter holding in the entity crosses 90%. If that is not possible, then the company cannot delist. Further, at least 25% of public shareholders should participate in the reverse book building. If a company is delisted with some shares still held by the public, then such shareholder should have the right to sell their shares to the promoters. Promoters offer to buy those shares at the exit price within 1 year. No minority shareholder can be forced to exit at the time of delisting of shares from the stock exchanges. A delisted share can come for relisting. SEBI, through its regulations, specifies the time limit post which a company can relist its shares. As per SEBI Delisting of Equity Shares Regulation of 2009, a company can apply for relisting, 1. 5 years after delisting in the case of voluntary delisting, and 2. 10 years after delisting in the case of compulsory delisting. Share swap. Swap simply means exchange of something. Accordingly, share swap means exchanging one set of shares with another set of shares. Term share swap is often used during a merger or acquisition of a company when the acquiring company uses its own stock as cash to purchase the business. Each shareholder of the acquired company receives a predetermined amount of shares from the acquiring company. Before the swap occurs, each party must accurately value its company so that a fair swap ratio can be calculated.